The One Big Beautiful Bill has been signed into law, and with that comes a number of tax changes that you should be aware of for the upcoming tax season. So in this video, I'm going to highlight a number of the tax changes that I feel are the most impactful for the most amount of people. So do understand, I'm not going to be digging into everything about everything on this bill, just a number of the things that I think are most pertinent to you and you should have a heads up on. And in addition to that, do understand that I don't have a whole lot of additional context or guidance on these tax changes as it's brand new law. Over the coming months, we will be giving more guidance and education on how these tax changes will play with other things in the tax code. But until that time, let's at least see what are some of the major changes that have occurred with this new bill. So with all that said, let's go and take a look at things that happen on the personal side, and after that, we'll take a look at things that happen on the business side. Let's dig in. So first things first, the TCJA increased standard deduction amounts have been made permanent. Now do understand, whenever I say something has been made permanent from the TCJA, the Tax Cuts and Jobs Act of 2018, that means there is no longer a sunsetting provision for this part of that tax code. You see, previously there are a number of provisions within the TCJA that would sunset after a number of years and revert back to the 2017 tax law. But when these things are made permanent with the One Big Beautiful Bill, that means they no longer have a sunsetting provision that will take them back to pre-2018 tax law. And this is the new tax law until a new administration comes in and makes their own tax bill that changes this. So that's what I mean by that. And in addition to those being made permanent, they also increased a little bit more than what we had originally anticipated them to be for tax year 2025. For instance, the single standard deduction for single filers will be $15,750. The head of household standard deduction will be $23,625, and the married filing joint standard deduction will be $31,500. Slightly up from what we originally had seen would be the 2025 standard deduction amounts. The second thing, and a huge change that a lot of people wanted, is the $10,000 state and local tax SALT cap has been increased to $40,000. As long as you make $500,000 or less in adjusted gross income, you will be able to deduct up to $40,000 of state and local taxes. That would be things like your property tax, your sales and use tax, your personal property tax on vehicles if you have that in your state, or your state income tax that you paid, like withheld on your W-2 or just paid that year. Now do understand, if your income goes over $500,000, then you will see a phase down of the SALT cap from $40,000 down to as low as $10,000. So you won't phase out completely, but it will phase back down to the $10,000 cap depending on your level of income. Another change within the tax code, the child tax credit will now be bumped up from $2,000 to $2,200 for tax year 2025. And it will now be indexed for inflation. So in 2026, it will increase again. We just don't know what to until we figure out what the inflation adjustments are going to be. So that is a welcome change for the child tax credit for sure. There's also an additional deduction that seniors will be able to take on their tax return. If you are 65 years or older, you'll be able to get an additional $6,000 added to your standard deduction. And if you're married filing joint and your spouse is also 65 years or older, you'll get an additional $12,000 added to your standard deduction that you'll be able to take against your income. Now do understand, this will phase out for taxpayers who make over $75,000 if they're a single filer or over $150,000 if they're a married filing joint filer. But if your income is at or lower than those adjusted gross income amounts, you'll be able to get an additional $6,000 to $12,000 on your tax return as a standard deduction. The bill did permanently extend the TCJA's provision limiting the amount of mortgage interest deduction that one can take to the first $750,000 of home mortgage acquisition debt, but it did also allow for certain mortgage insurance premiums on acquisition indebtedness to be treated as qualified residence interest. That means that certain mortgage insurance premiums might be able to be deducted as an itemized deduction for you. Another provision from the TCJA that was made permanent was the limitation on being able to itemize personal casualty losses to only those that happened in federally declared disaster areas. Now that said, the bill actually did expand a little bit on this by saying that some state declared disasters could also have some itemizable casualty losses. But for the most part, in order to take a casualty loss itemized deduction, it's going to need to be in a federally declared disaster area. The bill did also make permanent the elimination of the miscellaneous itemized deduction, which would be like where if I'm a W-2 employee trying to take a home office deduction or a mileage deduction, I haven't been able to do that since 2018 because miscellaneous itemized deductions are gone. that is permanently gone per this bill. Something new that the bill brings in is limiting the amount of gambling losses that you can take as an itemized deduction. It used to be that you can take all of your gambling losses just to the extent of your gambling winnings. For instance, if you made $10,000 in gambling winnings and you had $20,000 in gambling losses, well, you could itemize up to the $10,000 of winnings that you had. So you can make it $0. Now you are limited to 90% of your gambling losses and then to the extent of your gambling winnings. So for instance, if you had $10,000 of gambling winnings and $10,000 of gambling losses, you would only be able to itemize up to $9,000 of those losses. Now that said, if you had $20,000 of gambling losses and $10,000 of winnings, then that means the most you could itemize of your losses would be $18,000. But because you only had $10,000 of winnings, you would lower that down to the extent of your winnings. You'd lower it down to $10,000. So it's not that you always have to do 90% of your winnings, but you have to do 90% of your losses as potentially itemizable. So that is an interesting change for sure, and my suggestion is just make sure that you are really tracking the amount of losses or amount of money that you're paying when you're gambling so that you can itemize as much as you can to mitigate those winnings. So then there's one of the big new ones, no tax on tips. So the bill provides a temporary deduction of up to $25,000 for qualified tips received by an individual in an occupation that customarily and regularly receives tips. Now understand, this deduction is allowed for both employees receiving a W-2 or 1099 contractors. And the deduction would be an above-the-line deduction, therefore it's available for taxpayers who claim the standard deduction or itemized deduction. Just like if you were to take an IRA deduction or an educator expense deduction. An above-the-line deduction happens before your adjusted gross income, not before your taxable income like the standard deduction or itemized deduction does. So whether you itemize or you take the standard, you'd be able to take this deduction as well. But do understand, the deduction begins to phase out when your adjusted gross income reaches over $150,000 as a single filer or over $300,000 if you're a married filing joint filer. And do understand as well, this is a temporary deduction. It's for tax years 2025 to 2028 as of the time being. We don't know if this will be made permanent. This is going to have a sunsetting provision. And much like that, there's also the other new provision, no tax on overtime. So the bill provides a temporary above-the-line deduction. So just like no tax on tips, it's above-the-line deduction. Doesn't matter whether you take the standard deduction or itemize, you'll be able to take this deduction. And the deduction is for up to $12,500 or $25,000 in the case of a joint return for qualified overtime compensation received by an individual during the given year. The deduction does begin to phase out. Same levels as no tax on tips at $150,000 single filer, $300,000 married filing joint, and again is temporary from tax years 2025 to 2028. Another new provision from this tax bill is the car loan interest deduction. This would be a deduction for the interest paid on your personal vehicle, so it's personal loan interest deduction. This does have an income phase out of $100,000 for a single filer or $200,000 for a married filing joint filer, but it does not appear to be an itemized deduction. It's not listed. In fact, it's listed specifically not as an itemized deduction, so that would make it an above-the-line deduction like no tax on tips or no tax on overtime. I'm very curious for more guidance on this deduction for sure. Now going back to some old provisions of the tax code that got a little bit of a revamp in the new bill. The adoption credit. The bill makes a portion of up to $5,000 of the Section 23 adoption credit refundable, and the amount will also be adjusted for inflation. Another revamp to an old provision would be the Dependent Care Assistance Program. The maximum annual excludable amount from income under Section 129 Dependent Care Assistance Program that employers can offer their employees, to be able to pay in to their dependent care. It used to be $5,000 that you could pay in out of your W-2. It is now increased to $7,500 that you can pay in towards your dependent care. Now it's going to be deductible from your wages. It's a pretty good deal. I would definitely take advantage of that if your employer offers it to you. Charitable contributions also got a little bit of a revamp. The bill creates a charitable contribution deduction for taxpayers who elect not to itemize, allowing non-itemizers to claim a deduction of up to $1,000 for single filers or $2,000 for married filing joint filers. But they also created a 0.5% floor on charitable contribution deduction for those who do itemize, which means now, like with itemizing your medical expenses as a 7.5% floor, which means until you pay more than 7.5% of your adjusted gross income in medical expenses, you will not begin to itemize your medical expenses. For instance, if I make $100,000 of adjusted gross income, I have to have more than $7,500 of medical expenses to begin itemizing those things. So now with this floor created for charitable contributions, until you have more than 0.5% of your adjusted gross income in charitable contributions, you won't be able to itemize them, unless you elect not to itemize, and you can take up to the $1,000 or $2,000 depending on your filing status as a non-itemizer. At least so far as I understand what has been written in the bill at this point in time. So that brings me to the end of the changes on the personal side of this tax bill. Now let's take a look at some of the changes on the business side. 100% bonus depreciation is back. And not only is it back, but it's been made permanent. And what I mean by that is there is no sunsetting provision that's going to start taking this down to 80%, then 60%, 40%, down to 0. No, 100% bonus depreciation is the law of the land. If you buy eligible property in your business after January 19th, 2025, it is eligible for 100% bonus depreciation in the first year. And what that means is you can finally go back to the Mercedes-Benz dealership, buy that G-Wagon, write it off in the first year like you've been wanting to do, because bonus depreciation is back at 100%. In addition to bonus depreciation, the other accelerated depreciation method of Section 179 got a little bit of a bump. Now it's up to $2.5 million of qualifying property can be Section 179 in 1 year. Another provision of the tax bill that's going to help a lot of businesses is in research and development expenses. The bill allows taxpayers to immediately deduct domestic research and experimental expenditures paid or incurred in tax years beginning after December 31st, 2024, which means instead of having to amortize their domestic research and development expenses, they're now able to immediately deduct them, like they were able to do a number of years ago, but that sunset in the TCJA provisions and has been a little bit of a burden the past few years. And so I know a lot of businesses have been hammering Congress to get this done, and I know a lot will be happy that this has been put back to immediately deductible. Another provision of the TCJA that's been made permanent is the QBI, or Qualified Business Income Deduction, that 20% of your business income deduction that you're able to take on your taxes as a business owner. That has been made permanent, so we do not see anywhere in the future that this will be going away at this point in time. The bill also makes opportunity zones, like qualified opportunity zones, a permanent feature of the tax bill. That said, there are some narrowing definitions for what a low-income community is. That said, those are going to extend past the January 1, 2027 date that they were planning to expire under the TCJA rules. And then lastly, a number of the green credits from the Inflation Reduction Act are going to be terminated, such as the clean vehicle credit or the residential energy credits. Those are going to go away. They are not going to be terminated as of the signing of the bill. Many of them are going to be terminated as of September 30th of 2025, some of them later, some of them in 2026, some of them in 2027, some of them in 2028. But that said, a lot of those green credits are going away. So if there's anything that you're looking to take advantage of, solar or buying a Tesla, getting the credit, any of those things, you have a little bit of time to get them done, but you'll want to go get them done this year, more than likely before September 30th, in order to be able to utilize them on your 2025 tax return. Throughout this video, you've seen screenshots of the Journal of Accountancy's article on all these tax changes. I use that article as the reference point because it's a little bit easier to read than the bill itself. I did verify a lot of these things to the bill, and the Journal of Accountancy is a reputable source for a lot of these things. So I figured that would be a good source for you to go take a look at for a quick summary of these tax changes that's easy to read, and you can easily go find more information in the bill itself. I will link both of those in the description of this video. Thanks so much for watching. Be sure to like, subscribe, comment, and hit that notification bell. And be sure to follow me on TikTok and Instagram, where I will post a lot more short form content, probably answering a lot of questions about these individual provisions within this new tax code as more guidance and context comes down the pike. Once again, thanks so much for watching, and I'll see you on the next video.